What is free cash flow to firm? The cash flow which is arrived before having any cash transaction with equity shareholders, preference shareholder and debt. Then what is free cash flow to equity? Before having any cash transactions with equity. Now what is discounting rate applicable? The discounting rate applicable here is weighted average cost of capital and the weights are according to the respective capitals. What is discounting rate applicable in case of equity? The discounting rate applicable is cost of equity. Now let's see the formula. Okay, in both the cases, first we will start with earnings before interest and tax. The earnings before interest and tax are before paying interest, that is payment to debentures, before paying equity dividend and before paying preference dividend. Okay, from earnings we will first deduct tax applicable, then we will add back any non-cash item, that is depreciation. From there, first we will add if there is any negative change in non-cash working capital, and we will deduct if there is any positive change in non-cash working capital. Example, say the company's stock has increased or the company's debtors has increased in comparison to last year, so the cash available would have been blocked in stock or debtors. So we will reduce if there is any positive change. From there, we will give effects of changes due to investment activities. If company is purchasing any plant and machinery, the cash available would have been reduced due to the funds blocked in investment activities. If there is any positive effect of cash flow, that is sale of plant and machinery, then we will add that. Now let's see from free cash flow to firm how we will arrive at free cash flow to equity. We will make the payments to preference shareholders and debentures. What are the two payments? Two type of payments. One will be interest and dividend, and the second payment would be repayment of their capital. Okay, there could be any new funds raised from preference shareholders and debt. Also, if there is such case, we will give effect of fundraising from debt and preference. See, this is the comparison. Free cash flow to equity equals to free cash flow to firm minus payments made and receipts from preference and debt.